Hello, and thank you for attending Tax Declassified. I'm Tim Taylor. I'm financial professional for the Wingate Group. Today, we're going to take an in-depth look at one of the biggest and least recognized risks that we face in retirement: taxes. Unnecessary taxes can be one of the biggest expense in retirement if it's not properly planned for. Here at the Wingate Group, we believe in the holistic planning when it comes to retirement, and taxes are a big part of that retirement puzzle that many firms often ignore. More importantly, we strive to be an informational resource for our community, which is one of the reasons why we have this special webinar today. You know, I've had a number of clients come to me in the past that they've thought they've done everything that they could do and what they were told to do to plan for their golden years, only to find out they had not planned for taxes. My guests today are co-authors of the new Holistic Retirement, the No Compromise Retirement Plan, and the New Rules of Retirement Savings, Neil Wilding and Becky Swansburg. Now, both Neil and Becky are going to give us an insider's perspective of how legislation is changing in Washington, D.C., and how it could increase the risk of taxes on our retirement, and how shifting your tax strategies from a micro to a macro approach could potentially reduce your lifetime taxes and position you for success in retirement. So without further ado, it is my great pleasure to introduce two of the industry leading experts, Neil Wilding and Becky Swansburg.
Hello, welcome. Today we want to discuss one of the largest, least understood retirement risks facing American savers, and that is the risk of rising taxes in retirement. Now, if you have saved all or the majority of your retirement funds in a 401k or an IRA or a 403b, any of these tax-deferred savings vehicles, this webinar is for you. Now, I'm Becky Swansburg, and I'm joined here by my colleague, Neil Wilding, and we are authors of the New Holistic Retirement, which is a book that we wrote to help savers like you understand and address the complete set of risks that they may face in retirement. And later on in this webinar, we'll be sure to show you how you can get a complimentary copy of this book. Now, we bring very unique backgrounds to our approach to retirement savings. My background is actually in government and policy. So I spent my early career in Washington, D.C., where I worked in the White House and then over on Capitol Hill for the Speaker of the House and several members of Congress. And my time in Washington really helped me understand that the debates and the laws being discussed in our nation's capital have a direct impact on the success or failure of your and my retirement approach. Now, Neil has spent his entire career helping savers like you identify and mitigate emerging risks. Emerging risks are the new risks that we face based on current environments today, and they're often risks that our parents and grandparents never had to consider. So let's look at one of those risks right now. Now, undoubtedly, as you have saved for retirement, your goal has been to make sure you have enough income in retirement to last as long as you do. Now, on that path to that goal, oftentimes we are very focused on growth, and growth is absolutely a key component of a successful retirement approach. We want to make sure that your account earns enough money and then is protected from market downturns so that you can generate significant income in retirement to fund that retirement that you have in mind. But equally important to growth and protection of your funds is taxes. And that's because taxes represent the portion of your funds that you get to keep. And it is just as you are concerned about growing and protecting your funds, we have to make sure that we have prepared for how much of our funds we're going to send to the IRS in the form of taxes and how much we get to keep in the form of income. And I'm going to turn over to Neil and let him show you dollars and cents why taxes deserve equal weight in your retirement approach as the growth and protection of your funds.
Yeah, thanks, Becky. And, that's a bold statement that you're making. And my guess is some folks in our audience are thinking, well, wait a minute. I understand that taxes can play a role, but really, equally important to the growth that I could potentially get from my portfolio. So to help kind of back up what we're saying here, we're going to put some numbers behind those words, and let's just do that through an example. So let's just say we have a 64-year-old. My guess is many of you in the audience today might be 64 years old, pondering retirement in the next year or two. In this example, we're going to assume that retirement starts next year. And I'm going to give you $1 million IRA. And I'm just going to project out a nice, simple, systematic withdrawal from that IRA and make it last to age 100. And so in order to do that, I need to make some assumptions, and we'll call them goals. And let's just set as our goal that we're going to have a 50-50 portfolio. Because if we're, reaching, the retirement income phase of retirement, we need to have some balance in our portfolio. And so I'm going to assume half of the portfolio is in an equity type investment that's providing an 8% return, or at least we'll set that goal of 8%. And then I'm going to say the other half of the money is in some sort of conservative fixed income type instrument we're going to set the goal of about 2.5% return for our example. And I'm going to assume an effective tax rate of 20%. And so if we have all of those metrics in place and we hit all of those goals, then starting at age 65, I could actually take after taxes a $50,000 distribution and make it last all the way to age 100. Now, again, that's assuming that everything went well and that we met all of our goals. Now, what I'm going to first do is say, well, what if we don't meet one of those goals? What if instead of earning 8% from the equity markets, let's just say that we only earn 5%. Now, my guess is many of you realize, okay, well, if I don't meet my growth goals, then I'm not going to have as much money for my retirement. And so that $50,000 is in jeopardy. And that's absolutely right. So if half of our portfolio underperforms, again, so we're looking at a 50-50 mix here. So if just half of it only gets 5% instead of 8%, then we have to take a pay cut in retirement. And that pay cut is going to be to the tune of, you're getting $42,000 a year instead of 50. And so if we're looking at a 35-year retirement, that's quite a significant cumulative cut in payment and retirement assets that we're going to have, or retirement income that we're going to have, simply because we underperformed our performance. But that's not earth-shattering. My guess is many of you already understand that. Okay, sure, if I earn less money, I'm going to get less money in retirement. But see, now what I'm going to do is I'm going to change one of the goals that we miss. And I'm going to say that you did everything right now. And let's go back to where we are earning the full 8% from the equity component of the portfolio. And we do earn 2.5% from fixed income. And we maintain that 50-50 portfolio throughout. But the problem that we have, or the change that I'm now going to make to this example, is the IRS. And so what I'm going to change is say, you know what? The IRS decided, and by the way, they have full authority to do this. They decided in this example, you know what? We've been spending a lot of money on our initiatives, and we need some revenue to back that up. So instead of needing 20% of your retirement, now I need 30%. Now pause that for a minute. That is authority that the IRS has. They can change the rules at any point, and that's why this can be such a risk. And so in this example, if they do, again, you did everything right. The portfolio did everything right. But suddenly now, because the IRS decided they need more money, your retirement income is impacted. Instead of earning $50,000, you would only have after taxes $43,000 a year in retirement. And so I'm not here to compare and contrast the 42 versus 43. I'm just here to say they're in the same ballpark. And so when you think about that picture that Becky painted for you up front, you see, yes, okay, so of course, growth and the lack thereof, or potential lack thereof in my retirement could certainly impact my retirement. But so can the IRS changing the rules on us, and so can taxes. And so that's why this topic is so important, and why I'm glad you've joined us here today. So now that we've talked about the fact that the IRS can change the rules on us, and they could actually have such an impact, I'm going to kick it back to Becky and just let her talk through, okay, how likely is this? And if it does happen, how much could it really change? So Becky, you want to take it from here?
Thanks, Neil. All right. I truly believe that we are in a rising tax environment. And a rising tax environment means that taxes in the future are likely to be higher than they are today. Now, why do I say that with such confidence? And it's not just me. Why do experts across our industry feel that higher taxes are coming? Well, it's just based on the last few years of economic and government action reality in our country. So let's start with the fact that our federal debt is currently over $30 trillion with a T. Now, our debt has been large and unsustainable for some time, but it was not helped by all of the economic stimulus spending that has occurred since the pandemic began in 2020. But it's not just the stimulus spending bills that have driven up the debt. Right now, Congress, from both parties, it seems, tends to be very spend happy. They are coming out with new proposals all the time to spend more dollars. And of course, what does that do? It often drives up the debt. So our federal debt has increased by over $2 trillion this year alone. It is large and unsustainable. How do we address a growing debt? Well, two options. The first is we can have such a robust economy that we generate so much tax revenue as a country and we can pay down our debt. I'm pretty sure if I could see you all raising your hands, very few of you would raise your hand and say, I bet that's the way we're going to go. Because the other way we can address the debt is by raising taxes. I think that's our most likely approach. And I believe it for the reason that many experts believe it. And it's this: Congress has already been debating trillions of dollars of new tax and spending legislation. So we have seen new initiatives, everything for expanded access to healthcare, education, transportation, green energy, agriculture, you name it. And there seems every time you pick up the newspaper or turn on CNN, turn on Fox News, there seems to be a news story about a new spending bill or a new priority Congress wants to fund. But here's the thing. How do they fund all that new spending? Well, they fund it with new taxes. And over the last year, it has been interesting, deeply interesting to myself and many other experts in the industry to see where some of those new taxation policies are focused. Because surprisingly, many of them have been proposals that impact IRAs, 401ks, and even Roth accounts. So we have heard congressional debate on proposals to limit contributions to tax-deferred spending for some Americans, to implement new tax requirements and new tax policies on 401ks and IRAs and even Roth accounts. What I like to say is that in the past 12 months, we've really seen Congress tip its hand. And suddenly, we've gotten to see the kinds of areas where they expect more tax revenue to come in the future. Now, if you've been following politics like me, you know some proposals have passed, some are still being debated in Washington, and some have been sidelined for the time being. But if there's one thing I know from my time on Capitol Hill and in the White House, it's that tax proposals never die. They just go on the shelf for future use. So in a way, the last 12 months of debate has given us a gift because we now know that retirement savings is one area where Congress is looking to generate additional tax revenue for our government to fund all this new spending. And that should impact all of us because of this legislative risk. Now, as we said at the jump of this call, a lot of you intuitively know that you have to mitigate market risk as you save for retirement. We have to balance growing our assets and protecting them. And hopefully you know by now that you also need to mitigate income risk. Maybe you've incorporated annuities into your retirement approach to make sure that you've planned to make your income last as long as you do. But tax risk and legislative risk deserve equal consideration. So what is legislative risk? Simply put, legislative risk is the risk that Congress changes the rules and those changes negatively impact your retirement approach. Each and every one of us should be focused on identifying legislative risk in our retirement approach and working to mitigate it. And here's why. Now, we've often heard the president and other members of Congress say this: Nobody making under $400,000 a year will have their taxes raised, period. And I'm here to tell you it is absolutely not true. And I say it's not true, not because I think the president's a liar or that Congress is being disingenuous. I really don't. The reason I know that this is not true is because our government leaders never consider the real way that taxes rise for savers like you and me. So I want to look at 3 ways that future taxes could be higher. And this is a great opportunity for you to consider, will any of these changes impact your retirement approach as you save and then use your money in the future? Now, tax brackets tend to be the most common way that we think about our taxes changing in the future. One thing that I think many baby boomers are realizing is that if they want to maintain their lifestyle in retirement, if they want to continue to travel and take their children out and buy, vacation homes and enjoy that full, rich life that they have worked so hard and saved so hard to achieve, well, if they maintain that lifestyle, chances are they're going to have to maintain the general level of income that funds that lifestyle. And if you maintain your general level of income in retirement to maintain your lifestyle, chances are you're not going to be able to get into that dramatically lower tax bracket in retirement, which means that this promise of tax deferred savings, that in the future your tax rates will likely be lower than they are today, may not be true for you if you want to maintain your lifestyle in retirement. But here's the thing. That's not the only way that tax brackets can change for you, because Congress can just change those brackets around you, even if you maintain the exact same amount of income. And actually, I know that this will happen in 2026. Now, how do I know that? I don't have a magic ball, but I remember that in 2017, Congress passed and the president signed into law comprehensive tax reform, sometimes referred to as the Trump tax cuts. Now, that legislation reduced tax bracket rates for millions of Americans, myself included, and probably everyone on this call today. But we have to remember, those tax bracket reductions were not permanent. And they sunset, they expire in 2025, which means that unless Congress passes new legislation to keep tax brackets low, all of our brackets are reverting to their older, higher rates come 2026. It means 2 things. Number 1, while it does not feel like it on April 15th when we pay our taxes, we are actually in an artificially low tax bracket environment today, thanks to those Trump tax cuts that are about to expire in a few years. Which brings me to my second point. If you are considering changing the tax status of any of your retirement assets, you can do so today at a discount because those rates are artificially low, but you have a limited amount of time to do it. So there is urgency around considering if you have the same tax diversification in your retirement approach as market diversification and income diversification. And as I speak to savers like you, many of them don't. Many of them have 100% or 90% or 85% of their retirement assets all in these tax deferred vehicles. And that leaves them completely exposed to tax changes in the future because they've pushed off their retirement tax bill to pay not today at known rates, but in the future at unknown rates. Now, while brackets are the most common way people think about their taxes changing, they're not the only way. There's also deductions. So if you make $100,000 of income and can deduct $20,000, you pay taxes on $80,000 of taxable income. Well, what if next year Congress changes the rules? What if suddenly you can only deduct $10,000? Well, now suddenly you're paying taxes on $90,000 of taxable income. Did your tax bracket change? Absolutely not. But did you end up owing more taxes to the IRS and having less to spend on yourself? You sure did. Now, deductions are important because as we age and enter into retirement, many of the deductions that Congress holds dear no longer apply to us, right? Child tax deductions, mortgage interest tax deductions. A lot of these things phase out as you enter and live in retirement. Now, this third way that taxes can rise in retirement is one of my favorites because it is where Congress gets creative. And that's just new things that they can tax. So a good example of this is like Social Security. You may be aware that today your Social Security benefit is taxable up to 85% of that benefit. But that wasn't always the case, and it certainly doesn't have to be the case going forward. Tomorrow, Congress could pass a new law saying 100% of your Social Security is subject to taxation. And if the president signed it into law, suddenly your tax bracket would be the same. Your deductions even might be the same, but you are paying more taxes and having less income to spend in retirement. These often have a trickle-down effect too. You may be aware that Medicare Part B premiums are based in part on taxable income from previous years. Well, suddenly if you have fewer deductions and more things being taxed, your Medicare Part B premiums go up as well. So this is why I truly believe that it is just as important to have tax diversification in your retirement approach as all the other ways that you diversify for retirement. And I'm going to bring Neil on and let him tell us a little bit about why this is so important and why maybe you've never really considered this before. So Neil, I'm going to turn it over to you.
Fascinating stuff, Becky. Thank you very much. So Becky just walked through all the ways that taxes can change. But many times what we hear is like, why has nobody talked to me about this before? And this is why I think it's important as you sit down and start to analyze the role of taxes in your retirement. It's important to change the lens in which we're viewing this situation. You know, if we're at a dinner party or we're talking about taxes and say, hey, I've got an opportunity for you to save some money on taxes, what are you probably thinking about? You're thinking about April 15th. And you're thinking about our tax return this year. And what we're here to suggest is that's a microwave. That sounded like microwave. So it's a micro way of thinking about taxes. But that's what we're here to do is kind of change the way we're thinking about taxes. And what I'm going to encourage you to do, and it's important for you to find a financial professional in your area that can think about taxes in a different way, which is a macro point of view. We don't want to just look at, say, hey, how can we save some taxes or save some money on taxes this year? We want to look at over my lifetime. And by the way, that kind of syncs up with how you should be thinking about retirement in the first place. When we think about how we're allocating our assets, we're taking a long-term point of view. When we're thinking about how we're building out an income plan in retirement, we're taking on a long-term point of view. It's important to think about taxes in the same way and thinking about, maybe it does make sense for me to go ahead and let the IRS have some of our tax revenue now and impact the micro, while knowing that in the long term, I'm going to be able to save significantly over my lifetime. And so now let's get through, and okay, it's one way to just kind of think about this and talk about taxes. But what about some analysis? And as you learned from before, I like to use an example. And so this is what we're going to do is we're going to walk through that example. And we're going to build a macro tax analysis. And so now I've got my 64-year-old example. We've got that 25% tax liability. And we're just going to assume that we're looking at $500,000 that's in an IRA. And we're going to assume it's growing at a 5% annual growth rate. And what we're going to do is we're going to project out not just what the tax bill is going to look like this year, but we're going to take that macro point of view and we're going to look over a lifetime. And so really, if we're saving for retirement and tax deferred assets, there are 3 different ways where the IRS actually collects revenue off of that IRA. Now, most folks, if they're continuing to defer taxes as long as possible, you can do that up until age 72. And at that point, that's when required minimum distributions start. And so that's usually, for most people, the first time that their IRA money is taxed is through required minimum distributions. But you'll see from the slide, they're not done at that point because many people, once you take that required minimum distribution, they didn't really need to spend it. And so if that's the case, if we're going to take that distribution, but we're really not going to use it for income, that means at this point we're saving, we're continue to save, but now we're outside the shell of the IRA. And so now the growth on that money that was already taxed on the way out the door of the IRA is now taxed again as it continues to grow Think about that. That money was taxed once on the way out the door, but if we continue to save that money, it gets taxed again as it continues to grow. Now, the third way the IRS gets access to your money is at death. When we pass away, our heirs have to pay taxes on that money. And so if we're going to do a true macro tax analysis where we're going to look at the total taxes you're going to pay over your lifetime, we have to consider and calculate all three aspects. So in my example here, if I've got $500,000, again, it's growing at a 5% growth rate. Just through the required minimum distributions alone. Again, I'm 64, getting ready to turn 65. I'm not going to be taking distributions on my RMDs until age 72. But at that point, age 72, we're going to assume that you pass away at age 90. There's $204,000 of tax revenue generated just from the RMDs alone. Now, if we don't need that money, if we're trying to save that money for later, then we still have to pay that $204,000 in taxes. But if we're going to continue to save, now we're saving in a taxable account so that growth is then taxable again. In this example, there would be another $96,000 in taxes just from the side account that you create from the RMDs that were already taxed on the way out the IRA door. And so then when we pass away, there's more taxes to be paid on that money. In this example, there's $156,000 that the heirs would have to pay. So I'm sure you're starting to add this up in your head. Wait a minute, this can't be right. My $500,000 account that's worth $500,000 today, the IRS is going to collect $456,000 in revenue over my lifetime. It's somewhat of a shocking number. Now, what's nice is that as part of the follow-up to this event is you're going to be able to have your own analysis run for you. So you can see exactly what your retirement tax bill is. But what's nice is we don't have to just sit back and say, that's my fate. The IRS is going to make all that money. As Becky said earlier, you can actually take action and we can just let the IRS have their taxes early. And we can do that through converting those assets to what we call tax-free. And so in this example, I'm going to use a Roth IRA as a placeholder. And there's a couple of different options that you can use when you sit down with your financial professional in this conversion process. But I'm just going to use a Roth IRA. And so if we do that, and we're going to convert those assets, if we do that, then we can pay our taxes at known tax rates. And so again, I assume taxes were at 25%. So I go ahead and pay. That means my whole $500,000, you know what, IRS? Take that money now. And I'm going to pay 25% of my $500,000 IRA. And that's going to be in converting those assets. What's nice, why would we do that? Well, because now all of our growth going forward is tax-free. So we don't owe taxes on that money as it grows. And when we pass away, we don't owe taxes at death. And so my total tax bill is $125. And so you're starting to see, wow, I do have a choice. And as I mentioned, this is analysis that we can have run for you. And that's why it's nice to be working with a financial professional that understands and can run a customized report just for you on what your retirement tax bill is. Because we all have a decision. As we come to think about, okay, what are we going to do? Are we going to go down and just let the IRS take $450,000 of tax revenue off of my $500,000 IRA? Or do we want to take action today and reallocate those assets to what we'll call tax-free? And maybe we can make that tax bill be as small as $125,000. Now that is something that many people feel appealing. And so, as we start to, kind of talk through what my options are, a lot of people say, you know what, let's at least talk about how we can go down that path of 125. Now, we talked earlier, Becky came on, and I'm going to bring her back on to kind of talk through, okay, my rising tax risk. Neil, you just read my analysis, and in this example, we're talking about hundreds of thousands of dollars in difference in tax bill just based on when those taxes were paid. But you're getting ready to tell me that the analysis that I just ran was flawed because I assumed a level tax rate. And Becky spent so much time talking about how taxes could go up. Well, how does that impact this analysis? So I'm going to hand things back over to Becky.
Thanks, Neil. All right. One thing I get asked a lot with my background in tax policy and having worked in Washington, and I know someone on this call is already thinking it right now, is, okay, Becky, you've told us that we are in a rising tax environment. So how much are taxes going up? And the answer is, I don't know. I don't know. The president doesn't know. Congress doesn't know. We cannot predict future tax rates. But what we can do is look to history and see where tax rates have normalized in the past, and then apply that knowledge to think that that is a reasonable assumption of where tax rates could go in the future. And to do that, I like to use something called the middle quintile income. Now, if you are not familiar with the middle quintile, it's okay. You probably don't spend your days reading tax and economic papers. It's a very easy concept. If we took all U.S. taxpayers and put them into 5 buckets, the highest taxpayers would be in the highest quintile. The lowest taxpayers would be in that lowest quintile. And the middle income Americans would be in the middle quintile. Now, that's why I like using this measure. This measure tells us what is an everyday average American taxpayer paying now versus in the past. Well, the most recent middle quintile data we have is from 2018, which is after the Trump tax cuts in this current tax environment. So I decided to calculate, all right, let's see where middle quintile is today and where was it 20 years ago in 1998, 20 years from the last measure. Here's what's shocking. Middle quintile tax bracket rates in 1998 were 30% higher than they are today. So you know what that tells me? That tells me that Congress can raise tax bracket rates 30%, and we wouldn't even be in a high tax bracket rate environment. We would just be in a historical situation. Congress could raise tax bracket rates 30%, and it would only take us to the taxes we were used to be paying in the 1990s. That's pretty amazing if you think about it. And it really drives home that we are in this artificially low bracket environment. And that even if there weren't all that government spending, even if they didn't have so many new taxes that Congress is debating, even if we didn't have all that federal debt, if tax rates just normalized to the 90s, they would be 30% higher to today. So here's what I did. Neil just ran these potential taxes for that 64-year-old. But I said, what if 2026, when the Trump tax cuts expire, tax rates go up 30%? They normalize to those more historical levels. All right. At a 25% level tax, things were not looking great for our 64-year-old saver, right? But now if taxes rise in retirement, things look even worse, to the tune of $578,000 of taxes on that $500,000 IRA. That is the risk, not just of not having lower taxes, but of rising taxes in retirement. Because I almost forgot. What happens though if we convert to that Roth? Well, then we're protected, right? We don't have to worry about tax rates going up in 2026 because we have converted those funds at today's tax rates. We have, in essence, bought the IRS, right, out of our retirement account. And it is interesting because, I'm a small business owner, and I suspect some of you on this call are small business owners as well. And I always like to think, would I ever accept a business partner in my business that could change its ownership stake? And my answer is no. If you own 25% of my company, I give you 25% of the profit each year. And if next year you come to me and say, well, Becky, I'd actually like 30% of the profit, I would say to you, well, I'm sorry, you may want 30%, but you only own 25% of the company. But here's the thing. The IRS is a silent partner in your retirement account that can change its ownership stake at any time. And if you're in these tax-deferred vehicles that are so popular that I have, and I know you do too, these 401ks, these IRAs, Congress can change its ownership stake in the future, and there's nothing you can do about it. I would never accept it in my business, and I don't want to accept it for all of my retirement funds either. Because here's the reality you're faced with. You will make a decision this year about your future taxes in retirement, it is either a decision of action to buy out the IRS from a portion of your retirement accounts and pay those taxes now, or it's a decision of inaction where you just keep following along where you're going. And maybe you owe $450,000 in taxes over time, or wait, maybe taxes go up and you owe $580,000, or what? Maybe we just don't know. The one thing we do know is that we are in a volatile time of American policy coming out of Washington. And that it is just as we do not let all of our retirement funds be fully exposed to the market, we can't allow all of our retirement funds to be fully exposed to the whims of Congress and the White House anytime they might want to raise taxes in the future. It is absolutely critical that we convert a portion of those funds into something protected and hedged against those future tax increases. So I want to end with a quote, and then I want to tell you about a couple ways that you can take the next step to be an informed retirement, to be more informed in your retirement approach. So I love ending with this quote. It's by Judge Learned Hand. And if you're not familiar with Judge Hand, he was a U.S. Court of Appeals judge. He was actually the most quoted lower court judge by the U.S. Supreme Court, partially because he was brilliant and partially because he had a very sharp tongue and a lot of wit. And this is my favorite of his quote. He said, there are two systems of taxation in our country, one for the informed and one for the uninformed. It is my deepest hope that after watching this webinar today, you will always save under the system of taxation in America for the informed. You are incredibly fortunate to have a financial professional in your community who understands tax risk, who understands legislative risk, and who day after day helps savers like you protect their retirement approach from these risks. So I hope you'll do three things. You'll see a pop-up here in just a minute. One, schedule a 15-minute phone call. Let's learn about the options you have to reduce tax and legislative risk. We'll get you a complimentary copy of the new Holistic Retirement so that you can understand the complete set of risks that you may face in retirement. I know we've been focusing heavily on taxes today, but obviously that's not the only risk. And then finally, and most importantly, you'll get your own custom retirement tax bill run so that you can make an informed decision about the taxes you could pay in retirement and whether or not you are comfortable with that final number. So thank you for joining us today. I hope that you will incorporate taxes and understanding taxes in retirement into your retirement approach, because that is a way that you can help be prepared against the complete set of risks that you may face in the future, as well as be protected against the whims of Washington, because it may not get better from here. Thank you all so much for joining us today.
Thank you, Becky and Neil. We here at Wingate Group are firm believers in helping our clients find strategies to potentially reduce their lifetime taxes, to maximize their retirement income, and reduce the overall risk of their plans for retirement. Now, as Becky mentioned, we have proprietary tools that allow us to analyze our clients' retirement strategies and then structure a balanced plan that optimizes it for success in retirement. Now, each one of you in attendance today has the opportunity to meet with our team, to go through the strategy planning process and to see what steps you need to take today to stabilize your retirement for tomorrow. Now, the first step is scheduling a quick introductory call with myself to receive your free, no obligation retirement tax bill report. Now, this report will show you your potential tax bill and what it may look like in retirement and what savings it could look like with the proper tax strategies in place. Sometimes this means the savings of hundreds, if not thousands of dollars over the lifetime of your retirement. This could also mean more income to do the things that you love in retirement, or a more substantial legacy that you could leave for your loved ones or for the charitable causes that you support. Now, you can schedule a quick call with myself by using the scheduling link that should pop up on your screen. Our team will also be reaching out to answer any questions in the upcoming days to see where you would like to have your free, no obligation copy of the new Holistic Retirement sent. So with that, we would like to thank you for your time. We look forward to meeting you and will connect with each of you very soon.